So that we're up to ratio analysis. For this, I'm going to ask you to have the notes in front of you that go along with this, because I can't possibly, there's not enough room to write everything out we need to know. So my goal here is just to sort of work through some of these ratios and basically show you how they work, because some of them are a little tricky. So earnings per share, let's start with that. And I can tell you the one thing most students goof up on this one is right there. Earnings per share, it's your net income minus preferred dividends divided by your weighted average number of common shares outstanding. So earnings per share relates to common stockholders and common stock. And so when we are computing the income available to common stockholders, you have to deduct any preferred dividends. So now if you look at the problem that we're working on here, there's only common stock. There's no preferred stock, so there's no preferred dividends in this problem. So the preferred dividends would be 0. So it's just net income divided by the weighted average common shares outstanding, which at this level you'll just be given. You don't have to compute that. So we do that and you get $3.56 earnings per share. Okay, so that's fairly straightforward. You just have to remember that if there's no preferred dividends, you don't deduct the common dividends. Common dividends are given in this problem, and they pertain to the common stockholders, and so those are not, they're not part of this. It's only the preferred dividends that get deducted. Okay, so return on common stockholders' equity. Same thing here. It's minus any preferred dividends, no preferred dividends, nothing to deduct. But it's divided by average common stockholders' equity. And that can be a little bit tricky because stockholders' equity is made up of common stock plus retained earnings. And in a lot of problems, you will not be given the totals. In this problem, you are given the totals. So in another problem, you might have to look at it and say, oh, okay, the common stock is 280, the retained earnings is 286, so we get the total of that. So when you're doing that, that would be, the total common stockholders' equity, or the total stockholders' equity for would be 566,700. For the beginning, your total stockholders' equity is 465,400. You'd add those up, divide by 2, and you get that number, okay? But you have to remember that common stockholders' equity is both the common stock and the retained earnings that you have to add up and divide by 2. Okay, so that one's not too bad. Return on assets, that's also fairly straightforward. That's just the net income divided by your average total assets. So there you have to just make sure you're taking the total of all your assets, current and long-term, your planned assets and your current assets, add them at the beginning plus the end, divide by 2, and that gives you your average total assets, and there's your return on it, okay? All right, the current ratio is basically your current assets divided by your current liabilities. Okay, so this is your current assets, and that is given in this problem. Your current liabilities, they give you a total in this problem. A lot of times when you're doing the homework, they will not give you those totals. You have to know what a current asset is. So cash, accounts receivable, inventory, prepaid expenses, short-term investments, stuff like that. Not current assets, long-term notes payable, bonds payable. Those are long-term assets. So we're only looking for current assets and current liabilities. Okay, so your current assets and your current liabilities. All right. Now, the question is, once you get this, what does it mean? So you've got almost 370,000 in current assets, and you get about 200,000 in current liabilities. Are you happy or sad? Well, you're probably pretty happy because you've got more than enough current assets to meet your current obligations. So if your current ratio is greater than 1, that means that you supposedly have a pretty good situation. But sometimes with these, it's good to just put in simpler numbers and, just think about it a little bit. So if, say you have two companies and they've got, I'm just gonna keep it simple. Say you've got 100,000 in current assets and, go this way, 200 in current assets and 100,000 in current liabilities. So here's your current assets, current liabilities, and so they've got a current ratio of 2. So that's pretty good. But then what I want you to look at is, say, here's company A and here's company B. So company A, yeah, this is going to work here. So company A, here's company A and company B. And company A has cash, and they've got accounts receivable and inventory, okay? And both companies are going to have the same current assets of 200,000. But company A has 100,000 in cash, they got 50,000 in accounts receivable, and they got 50,000 in inventory. Okay, company B has 10,000 in cash, and say they got 90,000 in accounts receivable and 100,000 in inventory. Both of those total 200,000. They both have a really good current ratio. But which company do you want to be involved with? The one that has 10,000 in cash to pay their current liabilities of 100,000? Or do you want to be the one that has 100,000 in cash? They both got the same current ratio, or the same total current assets. So you'd have to ask here: are they not collecting their receivables? Have they, what's going on there? Are their inventories building up because they aren't selling stuff? What's going on here? So you can look at these numbers, but it's kind of good to start thinking about what they mean. Okay, so acid test ratio tries to get a little bit more at what the company can what they actually have available to pay their current obligations. So the top number here is just going to be cash, plus the short-term investments that presumably can be sold, plus accounts receivable. Notice there's no inventory in here, that's not as liquid. And so this is like the quick ratio, acid test ratio. If we had to pay things off right now, could we do it? Of course, the same caveat applies. Cash could be a very small amount of that, as in company B, or it could be a reasonable amount of it, as in company A. Okay, so that's that, and I think I'm going to do the, some more ratios in the next video.